Good evening, guys. So today we are back. Welcome back to my tutorial class. Today we will discuss about chapter 11, the project analysis and evaluation. So basically, in this chapter, we're trying to find the break-even quantity, both basically in accounting term, cash term, and financial term. We also calculate the degree of operating leverage and also a sensitivity analysis. Uh, my name is Ricardo, and I'll be your tutor. So we have two problems here. Problem one, which there is no tax here. We assume there's no tax, and the problem two, where there is a tax one. And it's also give us an example of a sensitivity analysis, which will be very helpful in predicting the future course. So moving on. So here we have problem one. Basically, this is all the stated information you have from the question sheet. And the next thing we need to do is basically we are trying to calculate break-even point. Basically, you just need to input the number into the formula. And in here, as you can see, in accounting break-even, you have depreciation. The reason is that we try to make sure that net income is zero. However, in cash break-even formula, you can see there is no depreciation here. The reason is that we're only trying to have an operating cash flow of zero. It's different because, again, depreciation is a non-cash item. So basically, you need to deduct that from the cash break-even point. Now, moving to the financial break-even. So basically, in financial break-even, you try to make sure that the project you're investing will give you a financial benefit of zero, or basically an NPV of zero. And in here in the formula, you can see that there is initial outlay divided by uh, present value factor. And in here, basically initial outlay divided by present value factor is OCF from the project, or at least the least amount of OCF you needed so that you will be break even. All the three formula will help you in generating thing certain thing for you, so it will give you some insight. And now we're moving to the B number. Here you can see OCF. So basically they're asking OCF when key is accounting break even. Basically there's a simple rule of thumb for this. So when accounting break even, OCF is equal to depreciation, and the reason is that the formula for OCF basically net income plus depreciation. That's a simple formula. So basically when your net income is zero because you're in accounting break even, that means OCF will equals to depreciation. So OCF will be this much. Next is about degree of operating leverage. In degree of operating leverage, basically this accounts for how much fixed asset you have to generate certain level of revenue. So in here, as you can see, it's basically telling you if I have more fixed asset, basically, or how I have more fixed costs, I will have better revenue. And the reason is that when you produce something, you have a production of certain quantity. And if you produce from the raw material until the finished product, basically you have certain added value. If you keep adding those value, if you're producing all of it, those added value will belongs to you. Basically, all the profits also belongs to you. However, if you have a bad year and you're not producing in the break-even quantity, all those fixed costs will be a burden to you. So basically, it will reduce your profit significantly. So meaning that if you have more asset, you will have more profit, but it's also come with a risk. If you are not producing enough, all those assets will become a burden or a extra cost to you. This is the reason why certain company try to outsource some of their materials or some of their process so as to reduce the risk from a bad year. Moving to problem number two, we can see here in the question sheet, basically you can have all of this information. Pay attention to their initial outlay and usable year so you can calculate the depreciation, and pay attention to these three as well. And again, there's tax in number two, so you need to pay attention to the tax. So in number A, basically we are trying to do a sensitivity analysis, and in the question it says that it is accurate to 10%. So basically the best case is 10% better for you and the worst case is 10% worse for you. And here is a little bit rule of thumb for that. So in best case, the price will increase, which is a good thing for you. A quantity will increase and the cost will decrease, basically more profit. In the worst case, your price will decrease, your quantity will decrease, and your cost will increase. How much is increased? It will be stated in the question sheet. So basically, in this case, it is 10%. So you have a best case. So in best case, you have 18,000. However, in best case, you will have an additional 10%. So basically, your price will be 10% higher. Your quantity will be 10% much. Your cost will be reduced 10%. In the worst case, your price will be reduced 10%. Your quantities will be reduced also by 10% from the base case. Okay? So I will show you that basically we're trying to find the NPV of those things. So the first thing we need to know is that we need to find an OCF or operating cash flow. If you can calculate the OCF, basically it will be a simple matter because we assume that from the production year, which is the useful year, which is 4th year, we are assuming that the OCF will be stable over the course of the years. There is no salvage value. Basically, the OCF will be stable. So I'll show you that in the base case, basically you can calculate it with this easy formula, or you can also calculate it in the form of income statement. Basically, you find the revenue first, the cost of goods sold, fixed costs, and depreciation, and you find the earning before tax, then minus tax, and you get the net income. And after you get the net income, again, remember, OCF basically mean adding back the depreciation cost, which is the same, right? The cost is the same. Now, after you find the operating cash flow, basically what you need to do is find the NPV. The formula is stated here. Basically, initial outlay, negative initial outlay, plus OCF time present value factor, which in this case, the present value factor formula would be the same everywhere. If you still remember your annuity programming, so basically it will be the same formula here. So basically it will be this B8 will be the rate of it, and the B2 will be the period, and the period will be the useful year here. Okay, so it will be a very helpful thing for you. Now, for the B number, we are trying to find a sensitivity base case. Basically, we're trying to figure out if a fixed cost change, how much does it will affect you. So in here, assume that the fixed cost, which is here 410,000, becomes 420,000. Basically an increase of 10%. So if there's an increase of 10%, basically you need to recalculate your OCF again. Basically it will be 10% low, 10,000 lower, and your NPV will be lower as well. As you can see, the NPV from 493 to 473, which is lower. And then for the sensitivity, basically you find the change of NPV divided by the change of fixed costs, or whatever variable you change, assuming the other variables are constant. So in this case, you will find that basically NPV 2 minus NPV 1 would be divided by fixed cost 2 minus fixed cost 1. This formula basically tells you that change in fixed cost will affect your NPV. And in this case, it is a negative 1.97, meaning that if the fixed cost increased by 1%, your NPV will decrease by 1.97%. And that's all there is to it. And again, in here, we are moving to the break-even point. So basically, in break-even point here, same formula. You see here, the formula in here for the cash break-even. Basically, you just need to input the number there. However, remember there is tax this time, so as you can see in my Excel formula, you can see that I input the tax here. So you also need to be reminded that every time you see tax and you try to calculate the break-even point, put in the tax back so that you can find the cash break-even point. And in here, in problem D, basically they want you to find the degree of operating leverage in accounting break-even point. So basically you need to find the accounting break-even point first. Again, remember there's depreciation here in accounting break-even. You can see in here B3, which is the depreciation. Remember, you need to add the depreciation in the accounting break-even point. And in here you can see the degree of operating leverage is the same formula, basically fixed cost divided 1 plus fixed cost divided by OCF. In this case, it's basically 1.96. So what this tells you is that when the quantity increased by 1%, OCF will increase by 1.96%. And the reason is that because your quantity that affects directly to your revenue, and the more fixed cost you have or the more asset you have, it will increase greatly. Okay, so that's it for today's class or for today's tutorial. If you have any question, you can ask me through WhatsApp, through Line. I'll be there for you. Thank you for listening. Goodbye.